You are watching Market Pulse Daily. Today is Wednesday, May 20, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Federal Reserve Chair Powell steps down, pro-crypto Warsh takes over as inflation surges. Today's agenda: Federal Reserve leadership transition and inflation shock, supply chain crisis deepens, Bitcoin's rainy day narrative, gold's correction and central bank demand, geopolitical tensions and oil prices, market update. Let's start with the biggest news: a seismic shift at the Federal Reserve. Breaking news this morning: Jerome Powell has officially stepped down as Federal Reserve Chair after 8 years. The Senate has confirmed pro-crypto Kevin Warsh as the new Federal Reserve Chair. This signals a major policy shift. Warsh has stated that quantitative easing, or QE, is fueling inflation. He believes the Federal Reserve should exit markets outside of crises. This is a completely different philosophy from Powell's approach. April's CPI data came in at 3.8% annually. That's the highest since May of last year. Core CPI also up less than 1% for the month. This indicates persistent price pressures. The European Central Bank, meanwhile, maintained its benchmark rate unchanged for the 7th consecutive meeting. Geopolitical risks continue to weigh on the European economy. Global Risks Report highlights geoeconomic confrontation and interstate conflict as top 2026 risks. WTI crude is trading at about $103, lower on the day, down about 4%. Market stress signals are increasing. The S&P 500 is down for the third straight session. The 10-year Treasury yield hit its highest level since early last year. Nvidia earnings reports are expected this week. Adding to investor uncertainty, markets faced nightmare fuel from the updated Federal Reserve inflation forecast. Wall Street is concerned about historically expensive valuations. The crypto market dropped to about $3 trillion in total market cap. Bitcoin is trading around about $76,706. Ethereum is at about $2,111. The Fear and Greed Index is at 27, signaling fear. Beyond the Federal Reserve, a persistent crisis continues to shape global markets. Beyond the Federal Reserve, a persistent crisis continues to shape global markets. The global economy is grappling with a severe hard bifurcation. Financial speculation has outpaced the physical capacity to produce essential goods. Critical materials like copper and rare earths are in short supply. These are vital for everything from AI data centers to green energy infrastructure. This is due to a collapse in physical industrial capacity. China's near-total control over the refining of these materials is a major factor. They are effectively weaponizing supply chains against Western needs. This supply-side collapse means the era of simply printing money to solve real-world scarcity is ending. The ability to physically build infrastructure is now the primary constraint. This threatens systemic crashes in key sectors like AI and green energy. The West's offshoring of manufacturing since the 1970s has left it dependent on foreign supply chains. This creates a structural deficit. It clashes with the growing demand for reindustrialization. While specific price movements for copper aren't detailed here, the narrative suggests upward pressure on commodity prices. Investors are increasingly rotating into commodity-heavy assets. They see them as superior cash-flowing options compared to stretched tech valuations. Keep a close eye on China's refining output. Also watch any geopolitical developments that could impact the flow of critical materials. The AI build-out and green energy transition will be directly constrained by the availability of these inputs. Physical scarcity, not financial engineering, is now the dominant market force. This creates significant risks for sectors reliant on critical raw materials. In this environment of scarcity and fiscal pressure, one asset is gaining significant attention. Amidst concerns of physical supply chain disruptions and potential currency debasement, Bitcoin is increasingly viewed as a hedge. The narrative is amplified by the unsustainable trajectory of U.S. government debt. Annual interest payments now exceed $1 trillion. This fiscal dominance, coupled with the Federal Reserve's limited options for tightening policy, creates a strong case for Bitcoin. It's seen as a scarce, non-sovereign store of value. The core argument is that the traditional system can no longer print its way out of physical scarcity. As central banks are trapped by debt levels, the focus shifts to assets that cannot be devalued or manipulated. Bitcoin, with its fixed supply and decentralized nature, aligns with this hard money narrative. This is especially true as AI-driven markets begin to value scarcity and network effects over traditional fundamentals. The document highlights a strong bullish signal for Bitcoin. There are predictions of it breaking its all-time highs before the end of the year. This outlook suggests reduced sensitivity to short-term volatility. The macro environment is seen as a catalyst for adoption rather than a risk factor. Pay close attention to U.S. government debt figures and interest payment trends. Also, monitor the correlation between Bitcoin and AI-driven equity movements. Watch any shifts in central bank digital currency discussions. Bitcoin's appeal is growing as a hedge against systemic risks. This is driven by fiscal unsustainability and the increasing recognition of its scarcity in an AI-powered economy. While Bitcoin garners attention, traditional safe havens are also telling While Bitcoin garners attention, traditional safe havens are also telling a story. Gold has experienced a significant correction. It's down about 1.6% from its January all-time high. This pullback has wiped over $1 trillion from the gold market cap. This is largely due to profit-taking amid rising yields. However, underlying support remains strong. Central banks, particularly in Asia, continue to accumulate gold. They purchased a net 244 tons in the first quarter. That's a 3% increase year over year. This sustained central bank buying highlights a growing concern about currency vulnerabilities. It also points to potential bond market runs. The argument is that global sovereign debt levels are becoming unsustainable. This makes gold a crucial hedge against a future debt crisis, a crisis where interest costs could become unmanageable. While some analysts dismiss Bitcoin, they acknowledge gold's historical role. It's seen as a survivor asset in times of economic turmoil. The market reaction has been a sell-off in gold prices. This is driven by momentum traders and profit-taking. However, the consistent buying from central banks suggests a floor is being established. A significant price drop is seen as a necessary step to flush out speculative positions. This is before a sustainable rally can begin. Watch the USD/JPY exchange rate as it approaches 160. A Japanese carry trade unwind could trigger broader liquidity shocks. Also, monitor central bank reserve reports for continued gold accumulation. Gold's recent correction is a healthy consolidation. Strong institutional demand and long-term debt concerns provide a solid foundation for its value. And in the energy markets, geopolitical risks continue to fuel price volatility. Oil prices remain elevated amid ongoing geopolitical tensions, particularly in the Middle East. WTI crude is trading around about $105 per barrel. Forecasts suggest Brent crude could reach about $110 to about $120. These price levels are driven by concerns over supply disruptions. These stem from regional conflicts and Iran's nuclear ambitions. Iran's nuclear ambitions are seen as a unique geopolitical risk factor. Elevated oil prices have a direct impact on inflation. They increase costs for transportation, manufacturing, and consumer goods. This adds another layer of complexity for central banks. Central banks are already struggling to control price pressures. Interconnectedness of global energy markets means instability in one region can have far-reaching economic consequences. The market reaction is characterized by sustained upward pressure on oil prices. While specific stock market reactions aren't detailed here, higher energy costs typically weigh on consumer spending. They also impact corporate profit margins. This could potentially lead to broader market weakness. Monitor developments in the Middle East closely. This includes any escalation of tensions or diplomatic breakthroughs. Also, keep an eye on the US dollar's strength. It often has an inverse relationship with oil prices. Geopolitical instability in the Middle East is a persistent driver of elevated oil prices. This poses a continued risk to global inflation and economic growth. Today's live market snapshot: metals, crypto, stocks, and bonds. Now for our daily financial market update. Here is where the key asset classes stand as of today. Gold is trading at about $4,480, slightly lower on the day, and is sharply lower over the past 5 sessions. Silver is at about $75, slightly higher today, and sharply lower over the past 5 sessions. In crypto, Bitcoin is at about $77,300, slightly higher on the session, and lower over the past 5 sessions. Ethereum is at about $2,150, higher today. Other major crypto: Solana at about $85, slightly higher, BNB at about $643, slightly higher, XRP at about $1.369, slightly higher. On equities, the S&P 500 at 7,353.6, slightly lower. The Nasdaq at 25,870.7, slightly lower. The Dow at 49,363.9, slightly lower. Internationally, the DAX at 24,368.6, slightly lower. The Nikkei at 59,804.4, lower. The FTSE at 10,285.1, slightly lower. On the bond side, the 10-year U.S. Treasury yield is at 4.7%, slightly higher on the session, and the 30-year yield is at 5.2%, slightly higher. Elevated yields continue to place pressure on risk assets and growth valuations. Rounding out the macro picture, WTI crude at about $103 per barrel, sharply lower. The dollar index at 99.37, flat. Euro-dollar at 1.16, slightly lower. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. Today, we're dissecting the seismic shift at the Federal Reserve, the ongoing battle against inflation, and the critical supply chain vulnerabilities that continue to shape our investment landscape. We'll also explore why Bitcoin is increasingly seen as a vital hedge in this evolving global economy. Thank you for your attention, and we will see you again tomorrow.